What's up, everybody? Last week's video was about Glen Kelman, the CEO of Redfin, and how he was manipulating the housing market by selling off all of his properties at a discounted rate. Well, since then, Kelman has announced that he is shutting down his iBuyer program completely due to the changing housing market. Kelman says he expects this downturn will run into 2023 and wants to minimize his losses. So what's the real story? Is this simply a smart business decision, or is Kelman admitting complete failure? And how will this affect the housing market? Let's dive right in. In a recent blog post by Glen Kelman, he said that iBuying is a staggering amount of money and risk for a now uncertain benefit. We've tied up hundreds of millions of dollars in houses that you yourself wouldn't want to buy right now. So what's going to happen to all these houses that we wouldn't want to buy right now? And by the way, what's wrong with them? Kelman also said in his layoff email that Redfin is laying off 862 brilliant, loyal people. He said his reasoning is that the housing market in 2023 will be 30% smaller than it was in 2021. The June layoff was a response to our expectation that we would sell less houses in 2022. This layoff assumes the downturn will last at least through 2023. He goes on to apologize to the departing employees and simply admits they just don't have enough sales to pay them. Redfin's iBuying program was particularly popular in markets like Phoenix and Las Vegas, according to Lance Lambert's article in Fortune magazine titled, "These bubbly housing markets look like bust, and they just sank Redfin's flipping business." Lambert differentiates between the iBuyer programs and just normal flippers because instead of creating value by renovating homes and then selling them, they use algorithms to make speedy offers directly to sellers, the service being that it reduces the hassles for sellers. As long as the iBuyers can quickly resell the homes, things should go smoothly. However, if home prices begin to fall, things can go south very fast. Well, we all know we're in the middle of a housing correction where prices are falling all over our country, so it makes sense that Redfin's getting out. As we talked about last week, Kelman stated that they are sitting on approximately $350 million worth of homes for sale that they either bought with their own money or worse, with borrowed money. In his words, what we always told investors is that we would protect our balance sheet by acting quickly. We don't have hope as a strategy. We immediately started marking down things. Lambert writes, by the end of January of 2023, Redfin expects to reduce its portfolio of homes down to 85 million. And by the end of the second quarter of 2023, all of its homes should be sold off. So if Redfin expects to offload all of its inventory in the next 6 or 7 months at a discounted price, that will accelerate the home price correction dramatically where they own a lot of homes. Whenever you have a large influx of homes coming on the market at the same time at a discounted price, it creates the feeling of a housing crash, like we had back in 2008 with all the foreclosures and the short sale. These iBuyers adjust home prices almost like clockwork if a home doesn't sell. So in some markets where they have a presence, they are also price setters in a faster way than past cycles. Rick Palacio Jr., head of research at Johns Burns Consulting, tells Fortune. And Kelman agrees that iBuyers and other investors who piled into the market during the boom are helping to drive down home prices much faster this time around. He already admitted that he prices his homes 2% lower than the last lowest comp, and if it doesn't sell in the first weekend, he immediately reduces his price again. And like I said last week, this is good news and bad news. It's good news for those buyers who have been priced out of the market because now hopefully there will be more inventory coming on the market at a discounted price. It's bad news for homeowners and sellers because these new sales will create the most recent comps that will bring down the values much quicker and much more aggressively than if it was just a normal seller coming on the market one house at a time. The iBuyer program runs off an algorithm that wants out first, and they are not afraid to cut prices aggressively to do so. Lambert writes that as of October, inventory levels are up 33% on a year-over-year basis. However, in bubbly markets where iBuyers are exposed, inventory growth is much more pronounced. In Phoenix, active listings for sale on Realtor.com are up 173% on a year-over-year basis. Markets like Austin and Salt Lake City are up 136% and 117% respectively. He gives an example of a 3-bedroom home that Redfin bought in Las Vegas for $600,000 in April. Just weeks later, Redfin listed it for $624,900. But it was too late. The Las Vegas housing market had already moved into correction mode. Fast forward to November, and the listing just got taken off the market after a series of price cuts brought the price down to $524,900. That's a $100,000 price reduction from its original list price, which most sellers would not withstand unless they absolutely had to sell. And this house in this example still hadn't sold as of November 10th when this article was published. I don't know about you guys, but I don't feel sorry for Redfin or any of these iBuyer companies or investors. They were out there buying so many homes in the last 2 years that could have gone to buyers who were out there fighting just to get a house. Lambert writes that even after all of these aggressive price cuts, iBuyers still have a tremendous amount of inventory to offload in those bubbly markets. In Phoenix alone, Parcel Labs estimates iBuyers still own around $1 billion worth of units. There, iBuyers sales transactions accounted for 10% of all Phoenix sales activity in September. As more pressure builds for them to exit their positions, they will likely become more aggressive in their pricing. This will continue a downward spiral until prices reach a point where demand enters to stabilize it. Jason Lewis, the co-founder of Parcel Labs, tells Fortune, all of the conditions are there for a housing crash in Phoenix. So maybe those buyers who were priced out of the market for the last 2 years will now be able to afford a home if prices get low enough, even with the higher interest rates. I guess we're just gonna have to wait and see what happens in markets like Phoenix and Las Vegas to see how low prices will actually go, because it looks like these markets will decelerate the fastest because they have a big iBuyer presence. Let's take a look at the latest housing market update that was published by Redfin to see the latest data regarding our current housing market. This was published on November 10th. For the week ending November 10th, 30-year mortgage rates increased to 7.08%. I've actually seen rates lower than 7% this week, but they change every day, so we'll just have to wait and see what happens. Fewer people searched homes for sale on Google than this time in 2021. Searches this week were down 28% from a year earlier, but ticked up 1 point from the previous week. Pending home sales were down 34% year over year, the largest decline since January of 2015, which is as far back as their data goes. So definitely less homes are going under contract, which makes sense with the higher interest rate. New listings of homes for sale were down 17% from a year earlier. Now, this is the time of year with the holiday season where new listings are going to be reduced, as you can see both in 2020 and 2021. But we are comparing the same time of year this year to last year, so we're still way lower than we should be. Active listings, the number of homes listed for sale at any point during this time period, were up 10% from a year earlier. Homes that sold were on the market for a median of 35 days, up more than a week from 27 days from a year earlier, and up from a record low of 17 days set in May and early June. And months of supply, a measure of the balance between supply and demand, calculated by dividing the number of active listings by closed sales, was 3.3 months, the highest level since June of 2020. So clearly, homes are staying on the market longer, so sellers are still going to need to adjust their prices. On average, a record 7.9% of homes for sale each week had a price drop, up from 3.6% a year earlier. So although this number has more than doubled from a year earlier, in my opinion, there's still not enough homes that are having price corrections for this to be considered a buyer's market. The average sale to list ratio, which measures how close homes are selling compared to their final asking price, fell to 98.7% from 100.4% from a year earlier. This is the lowest level since July of 2020. So if only around 8% of the homes are reducing their prices and homes are still selling at 98.7% of the list price, what this tells me is that sellers are either starting to price their homes at a more reasonable list price, or there just simply isn't enough inventory to create a significant price drop. It will be interesting to see if Redfin's offloading of their $350 million worth of homes for sale will affect this data in the coming months. But what's happening where you guys live? Do you see a lot of Redfin listings? Are you seeing more inventory, or are you still seeing multiple offers? Definitely comment below and let us know what you're seeing in your neck of the woods, because it just gives us a really good idea of what's happening in our housing market. I hope you guys got some value out of today's video. I really tried to bring you the most up-to-date news on the housing market so you can make the best decisions for you and your family. If you did get some value and you want to show our channel some support, definitely smash that like button, comment below, and consider subscribing to our channel. It definitely motivates us to make more videos. Thanks for watching. I do appreciate it. Bye!